Hello guys, welcome back to my channel. Don't forget to like, comment, share, and subscribe. Sentiment has loomed again this week in the wake of the U.S. Federal Reserve's guidance that it will continue to raise interest rates into next year, raising the pressures on other central banks to either do the same or risk a rapid depressions of their currencies. The German central bank had warned earlier in the week that the second of Europe's largest economy falling into recession were multiplying rapidly. While European Central Bank Isabel Schnabel told T-Online in an interview published on Thursday that Germany is likely to be hit harder than the rest of the Eurozone by the storage of Russian natural gas this winter. A recession might potentially be unavoidable here, Schnabel said, adding to the uncertainty in the Eurozone at the moment in the prospect of an Italian election which, opinion polls suggest, will return a right-wing coalition government under the leadership of Giorgia Meloni's Brothers of Italy party. The coalition's likely members have tempered their anti-EU and anti-EU rhetoric during this campaign, but doubts remain as to whether it will carry out the reforms that outgoing Prime Minister Mario Draghi crafted to ensure that Italy gets billions of euros in support from the EU for its recovery from the pandemic. Without those funds, the new Italian government may struggle to revive growth, especially in an environment of sharply rising interest rates that raise the cost of servicing its high debt burden. The yield on Italy's 10-year debt has already risen to over 4%. European stock lower. Macroeconomic outlook looks bleak. European stock markets weakened Friday as investors discussed a series of interest rate hikes in the region ahead of a fiscal update by the new UK administration. European equities are heading for deep weekly losses as rising interest rates across the globe threaten to sharply curtail economic growth, weakening on risk apathetic. The Bank of England hiked its benchmark interest rate by 50 basis points on Thursday, its seventh consecutive rise. The Swiss National Bank ended its period of negative rates, while the Norges Bank in Norway also hiked by 50 basis points and pointed to more hikes ahead. For the navigations, the Bank of England, the European the Macroeconomic Central Bank also raised interest rate last week and the Federal Reserve followed suit on Wednesday, but central banks hiking by an aggressive 75 basis points. The macroeconomic outlook in Europe is bleak, HSBC warned Friday. In a note, supply disruptions and the impact of Russia's war in Ukraine on energy and food prices continue to stifle growth and force central banks to tighten monetary policy aggressively to rein inflation. Investors will also focus on events in the UK, with new Finance Minister Kwasi Kwarteng set to deliver his first fiscal update to Parliament, a so-called mini-budget. He is set to provide more details about his plans to support the country's economy through which is likely to be a difficult winter. There was some good economic news. Spain upgraded its second quarter economic growth to 5% up from previous 1 to 1% announced 2 months ago, but both France and German manufacturing PMI data remained in contraction territory, with the region's industrial base suffering from soaring energy costs. In corporate news, Credit Suisse stock fell 2%, 7% on reports. The Swiss lender is once more forcing investors for fresh cash. It is attempts at radical overhaul of its investment bank. Oil prices fell Friday on course for a fourth consecutive weekly decline after a series of interest rate hikes around the world, including fears of a global economic slowdown hitting the demand for energy. The decision of Russia to escalate its invasion of Ukraine, mobilizing more troops to stem recent Ukraine gains, helped stem losses, but both contracts are on course for weekly losses of around 2% in the wake of the monetary tightening, led by the Federal Reserve. Futures traded 6% lower at barrel, while the Brent contract fell 5% to $89. Additionally, gold futures fell while AUR or USD traded 6% lower at 9,000. Down futures down. German and your bond yield hits 2% and dollar stability is at elevated, and the Nasdaq were present edged higher in early European trading Friday, remaining in demand after the Federal Reserve's hawkish stance, while the yen was buoyant after the invasion of Japanese authorities. Maybe that's all from me. Don't forget to like, comment, share, and subscribe. Thank you.